Hello, it's ChewDog Charts, and today we're going to talk about Dow Theory. It's a little like the tale of two cities. So let's take a look. Before we begin, a little bit of information about Dow Theory. Essentially, Dow Theory is an approach to trading that was developed by Charles Dow. Charles Dow, along with Edward Jones and Charles Bergstresser, founded the Dow Jones Industrial Company and then also developed the Dow Jones Industrial Average. Charles Dow wrote several editorials in the Wall Street Journal back in the early 1900s prior to his death in 1902. The Dow theory has undergone further development and refinement with some notable icons such as Richard Russell, who recently died in 2015 at the age of 91 just up the road in La Jolla. I used to read Richard Russell on a continual basis because he had excellent insight into Dow theory and the markets. Now, the Dow theory has 6 main components. We're only going to look at one component today, which is that the indices must confirm one another. So in order for a trend to be established, basically Dow postulated that the indices or market averages must confirm each other. And he used the Dow Jones Industrial Average and the Dow Jones Rail Average, which has been changed to the Dow Jones Transportation Average. Essentially, the average is closely watched to confirm the state of the U.S. economy, especially by those who follow Dow theory. The theory maintains that as the Dow Industrials make the products, the Dow transport the products. So the Dow Jones Transportation Average should confirm the trend of the Dow Jones Industrial Average, with a divergence indicating a potential reversal in the trend. In other words, if the Dow Jones Industrial Average is climbing while the Dow Jones Transportation Average is falling, it may signal economic weakness ahead, since goods are not being transported at the same rate at which they are being produced, suggesting a potential decline in nationwide demand. So let's go ahead and take a look at the charts. What we're looking at is the 20-year monthly chart, and it's the combination of the diamonds representing the Dow Jones Industrial Average, diamonds being DIA, and then IYT, which is the iShares Transportation Average, representing the Dow Jones Transportation Average. Now, it's not exact. However, for our purposes, it will serve well. If you want, you can look up the actual industrial average using $INDU in some charts, and the Dow Jones Transportation Average is $TRAN. But again, for our purposes, the DIA, diamonds, and the IYT will do well. Looking at the chart here, simply based on the price, you can see that the bottom in 2009 and both the diamonds and the IYT continued to climb and are at near record levels. However, I think when you take a look at the various oscillators, that may tell a different story. Let's first take a look at the diamonds. Again, looking at the 20-year monthly chart on the diamonds, we see that as of Friday, we were at near a record close at 234.43. Now, as we move down into the MACD, it looks like we have a very healthy uptrend with the fast line moving through the trigger line and continuing on up with perhaps some acceleration in the last 2 months. That acceleration is shown here by these two green lines, which are slightly higher than the previous histogram lines at this level here. So a little bit of acceleration. So nice and healthy with a strong upward move. Now we take a look further down here at momentum. Momentum confirms this with a nice healthy uptrend. We're near 50, which is a relative high period in comparison to the previous 20 years. Moving down to the RSI, the Relative Strength Index. And as I've talked about this in prior videos, we're at a very elevated level of 92.39, which is the highest level that we've seen certainly in the last 20 years, as shown by this chart, but a very healthy, strong uptrend here as well. The stochastics also confirm in the upper levels at 97.60 and 97.14 here, nearing that 100 level. Moving down, the volume simply is a little bit declining in the last couple of years, but not really all that negative. The Williams confirms the other oscillators in elevated levels. Here we are with a nice, decent upward trend. So let's now go ahead and take a look at the transports, IYT. Simply looking at the 20-year chart on IYT, it looks very healthy. It looks like we've bottomed here again in 2009 with a very good upward trend all the way through the current levels. It looks like we hit a record high perhaps on Thursday with a slight pullback on Friday to the current point at 171.12, and we're riding above the 20, the 50, and the 200 EMAs. All looks good. However, when we go down and take a look at the MACD, we start to see a little bit of a different story. Here, the high in the MACD was back in late 2014 into 2015, bottoming in mid-2016 with an upward move here. However, our current level is well below where we were in late 2014. And in fact, it looks like it's taken one attempt at breaking down, and we're currently in a second attempt at a possible breakdown. Now that breakdown is shown here in the histogram, where we peaked at this point in early 2017, but we have had a steady decline through the current time period. The momentum indicator also confirms that decline with these lower levels here, and then the current fall off at this point, down toward or moving toward the zero line, the midline. Going to the relative strength index, where, if you recall, the RSI on the diamonds was at about 90, just above the 90 level. Here we're at 59.37, but we see a slight decline here with lower highs as well as lower lows. This move down here hasn't bottomed yet. We'll see where that bottoms out, but I suspect that it's going to bottom out here soon, but still confirming some weakness happening in the indice. The stochastic is showing some sideways sawtoothing above the 80 or over bot level, but that's not showing anything significantly negative to me. However, we move down, we can see that the volume has taken a little sharper drop than it did in the diamonds, moving down in this direction here. The Williams also shows a little bit of a mixed bag. The upper levels are at this point here, but we can see that there's possibly a little bit of a breakdown in the lower lows, with the recent plunge heading down to the midline or negative 50. So although the overall price chart if you simply look at that, it looks nice and healthy. I think some of the undercurrents, the oscillators, are showing a little bit of a breakdown and the possibility of a non-confirmation coming in the move between the transports and the overall Dow Jones Industrial Average. So that's a red flag that I'd want to take a look at as an investor. It doesn't mean that we're going to have a crash tomorrow or anything like that. It's just simply a red flag that warns us as investors to pay attention and perhaps be prudent and don't lose money. So for now, that's ChewDog Charts. Thank you.